Hello, everyone. My name is Dan McCormick, and I'm here with Darren Hewitson, a senior fixed income portfolio manager at Siegel Bryant & Hamel. Today, we plan to discuss our current thinking for long duration portfolios and helping our clients with their specific liability situations. So let's begin. Darren, following the increases that we experienced in 2022, we've seen yields continue to move higher across the Treasury curve over the last few months, particularly for longer duration securities. What do you think drove us to this point, and do you expect any major changes?
Thanks, Dan. Yeah, it's been about a year since we last had a discussion on this similar topic, which we did in the wake of, amongst other things, the UK pension crisis in 2022, which saw a big sell-off in long-term yields. So it's interesting timing for a couple of reasons. The first being that we've actually seen a move of similar magnitude in long duration treasuries over the last few months. And the other thing that's timely is that we just had the Treasury's quarterly refunding announcement. And the reason I say that's interesting is that that's one of the things that we think precipitated the move over the last few months was actually the prior refunding announcement that came out in August. And that, I think, caught investors a little bit off guard at the time and where this move higher in yields and the steepening of the yield curve kind of started. So what does that mean? Well, in simple terms, it's more long duration treasury debt coming to market or more debt issuance. So if we think about a traditional supply demand type construct, it's a supply shock to the market. We then combine that with demand erosion, and this is something we've seen over the last several quarters from three large constituents of the market, as we see in this chart here: central banks, commercial banks, and foreign investors. Over the last decade or so, those three investor bases have comprised over 50% of the treasury market at times. And without getting too into the weeds on each of those, that support has been declining as those investor types have pulled back a little. So again, we go back to our kind of Econ 101, supply versus demand. We have a supply shock and we have a reduction in demand. So what does that do? Well, we know all else equal, that pushes prices down. Or in the case of fixed income, it pushes yields up. And that's kind of what we've seen. So we've obviously seen a more resilient economy, maybe than some people expected over the last few quarters. We continue to see volatility from a number of factors, geopolitical, for example. But those are some of the big factors we think have driven a lot of this move. And, we don't necessarily see a big change in those coming in the near term.
Okay, so if you put all that in a blender, where are you finding the opportunities now within credit?
Yeah, credit's interesting. So we'll continue our supply demand analysis, if you will, and kind of flip it on its head when we're looking at long duration credit. So long duration credit supply has actually been low and lower relative to expectations. And that makes sense for a number of reasons, right? Corporate treasurers are maybe a little less inclined to lock in these types of yields for longer terms. So we've actually seen supply lower than expectations. We then look at the demand side of the market, and this is something you'll hear me say a couple of times, but given the yields available, let's call it 6% or so on long duration, high quality fixed income, we've seen significant demand from a number of different investor types, including pension funds and insurance companies, just to name a couple. So putting those two things together, you kind of see the opposite to the treasury market. And that means that long duration risk premium or credit spreads have been very well behaved, if you will, and that's manifested in valuations in the market. The overall corporate bond market is sitting roughly at median spread valuations over the last 10 to 12 years, say. In the long duration markets, we're sitting around 10%, with zero being the tightest or the richest. So valuations are fairly full, but that said, we do still think there are pretty significant relative value opportunities within that. That can come in a number of different ways, maybe amongst the major sectors of the market, being corporate, industrial, financial, and utility. It could be individual industries within those sectors. We have different points on the credit or yield curves. 20-year, 30-year, 40-year maturities, for example, can all trade a little differently. Or, of course, idiosyncratic credit risk and individual credits out there in the market that we think may be a little mispriced. So valuations, I'd say on the whole, look fairly full. That supply-demand dynamic could also continue for a long time, but we think there are still opportunities within those cohorts for investors in this part of the fixed income market.
Okay. Well, you work with a number of clients that you utilize long duration. What are your clients thinking today about the role of LDI in their portfolios, and how can we help them and other investors with long duration mandates?
Yeah, the things that we've talked about definitely aren't going unnoticed, right? And in our view, it's still a pretty opportune time for looking at these types of strategies, or perhaps increasing allocations. If we focus on the pension market, there are kind of three primary factors that we could point to. One being very healthy funded ratios, and as a result of higher interest rates and also positive risk asset returns over time, funded ratios are sitting around 100% on average. The second being what I already mentioned, that available yields around 6% are higher than we've obviously seen in quite some time. And then lastly, as we can see in this next chart here, the average pension plan still only has about a 50% allocation to fixed income, with the other 50% being in equities and other investment types. So in our view, that third factor should begin to or continue to change or to increase given the first two factors that we outlined. Seems to us the prudent thing to do is to start increasing that hedge a little bit in light of that position. Now, every client's liability or set of circumstances, of course, is unique. And that's something where we feel we can help design those appropriate strategies for long duration investors to help take advantage of those factors that we see in the market today.
Very good. Thank you, Darren, for those valuable insights. And thank you, everyone, for joining us. Have a great day.